an invited talk, and the title is Models versus Markets, Forecasting the 2020 US Election. I'm thrilled that Harry Crane agreed to speak to us. He's an associate professor and also Chancellor's Excellence Scholar in Statistics at Rutgers University. He co-founded Researchers.one. It's a platform for peer review and scholarly publication and an initiative for intellectual reform. He's a fellow at the London Mathematical Institute. He has worked at UC Berkeley, at the RAND Corporation, and also the Foreign Policy Research Institute. He received his PhD in stats from University of Chicago and BA in math and economics from Penn. So thank you, Harry, for being here. And go ahead.
All right. Well, thanks a lot, David, and thanks to everyone for being here. I'm glad to have a chance to talk and to actually, it's good to it's always good to be, it's not usually good to be at the end, I guess, but it's good today because I was able to see Andrew's and Rajiv's talks, which were very close to what I'm going to, very much related to what I'm going to be talking about here. Although I might have some different opinions or some different conclusions to some of them. This is a bit of a case study, the models versus the markets in the 2020 election. I did something like this originally in 2018 midterms, but I got started a little bit earlier this time around. This was joint work with Darian Vincent, who's a student at Columbia, an undergraduate student actually. And our paper is available. David mentioned the Researchers.one platform that I started, and I'll say something a bit about that, some events that we have coming up a bit later on. So first thing, just to get started, I wish Andrew was here because the crux of this talk, I'll just get it out in the beginning, is, so Andrew was talking, well, should he have bet on his forecasts? And I say, absolutely yes. You have to bet on your forecast. If you don't bet on your forecast, then it's hard to know what they mean, and it's hard to actually know that you believe in them. So it's not enough to just say that you believe them. You actually have to put your money where your mouth is. And is it legal? Yes, it is definitely legal to do so. It's actually always legal to place bets. It's not always legal to take bets. Now, would it have been worth it? Rajiv gave a story saying that perhaps it would have been. Maybe it would have been, maybe it wouldn't have been. Maybe if Rajiv and Andrew had teamed up using Rajiv's methods, they may have been able to figure it out. But what I'm trying to do here is actually figure out which is better, models versus markets, models or markets, because during the lead up to elections, there's always arguments, and it seems to be it's a biannual or at least every 4-year tradition of who's got it right ahead of time. We want to know who's going to win and who should we trust. Should we trust the pundits? Should we trust the polls or the data journalists? Should we trust the prediction markets? And who's more reliable for this purpose? And of course, everybody knows that the pundits have their agenda. Pollsters, they may or may not have it. Some have an agenda, some don't. But they certainly may have their own biases. In this last election cycle, Robert Cahaly of Trafalgar was very much the outlier in a lot of respects. But in some ways, if you go back and look at it, he was more accurate than other pollsters. In a lot of cases, it really does depend how you look at it. And so really, one of the things that I want to do with this project is to say, well, what is the right way to look at it? Because there is a lot of opportunity for kind of after the fact, Monday morning quarterbacking and after the fact kind of post hoc adjustments. But the prediction markets actually provide a real-time system in which we, and not we, although I participate in these markets to some extent, the traders in these markets are in real time trying to predict an outcome. So they're putting their money out and they're saying, this is what I believe. And so, except for some exceptions, and there are certainly exceptions, we have to assume, or maybe we shouldn't, but the assumption would be that the participants in these markets have a vested interest in maximizing their profit and actually trying to make money in these markets. Question is, are they actually successful at that? Is their market price a reliable signal as to into what is the likely outcome of what is the likelihood of the outcome of these events. Now, in this workshop, I maybe don't have to convince you of, who cares about this, but I do think that it's actually worth looking at the bigger picture, because what actually got me interested in this problem in the first place was not an interest in politics at all, but it was an interest in, I think even Andrew said, what does it mean? There was a question in earlier lecture. What does it mean to say that something has an 85% chance? That gets to the meaning of probability. And I run a weekly seminar at Rutgers on the foundations of probability, which the reason I started this is a joint seminar with the philosophy department. The reason I wanted to get involved with this and to start this seminar in the first place was because to get at that very question. I actually didn't understand the meaning of probability in this very specific case, which was looking at the 538 forecasts in the 2016 election. So the story that I have for that was that I was in a seminar, in a lecture at Rutgers, and I was overhearing people talk before the seminar started. This was in September of 2016, and this was maybe 1 or 2 days after the first debate between Clinton and Trump. And I think that memory serves me, Trump outperformed himself, or what his expectations were, because I think the expectations for Trump were pretty low in that first debate. And so the 538 forecast went from something like Trump having, let's just say, a 15% chance to now all of a sudden having a 25% chance. And the people in this lecture, who I take it were not Trump supporters, were saying that they were starting to get nervous because now he has a 25% chance. So there was this really interesting concept to me, which is that they're putting some ground truth into these forecasts. Well, what is that ground truth? What is that meaning? And so that's something that I think these political predictions actually have much more to offer as a case study of that than just predicting elections. And I think that these apply beyond politics, things like all kinds of public policies, COVID response, replication crisis, peer review, things I won't talk about today, but understanding what these probabilities mean, I think, is crucial to actually giving meaning to the conclusions that they either support or don't support. So for the purposes of predicting elections or forecasting elections, which experts do we trust? I showed the pundits, I showed Hannity and Keith Olbermann. I'm going to leave them off of this discussion, and I'm just going to focus on the models versus the markets. And here we have the 538 forecast and the economist forecast, which actually doesn't show a number. But the economist forecast was significantly more in favor of Biden, to the extent of, I think, 95% by the time the election happened. And this was the final 538 forecast. Whereas down here, you can see the final market at Predictit, which had Biden 64 cents, Trump 44 cents. And then we have Betfair over here, which is, I don't have the implied probabilities here, which is actually seemingly even closer to 50-50. And so there's a discrepancy between the models and the market. So this leads to debate over where that discrepancy is coming from. Is it because the polls are all biased and have systematic error? Is it because the markets are filled with so-called MAGA money, people who just want Trump to win, and so they put money into the markets? Or is it something in between? Rajiv showed something very interesting, which was that the average of the two actually outperforms either one. And that's not at all surprising to me, because that's a technique that I've used in actual betting. That's an actual technique that you can use to refine your forecast. Usually, if you have information in your model, there's information in these forecasts, but there's also information in the markets. And so taking an average of the two makes sense in that there's things that are missing from the model, there's things that are missing from the market, assuming that my model has any kind of signal in it, some kind of signal in it. And so taking an average often does serve the purpose of refining the forecast and being more profitable. So I would actually be interested in if Rajiv would do an optimization to see what the optimal weight would have been to optimize Breyer score. Would you have put more weight on the model, or would you have put more weight on the markets? I'd just be curious to see that. Usually in my experience, you put more weight on the markets, even if you have a very strong model, just because markets tend to be pretty efficient. Okay, just for a quick introduction, which you probably don't need at this point, what's the difference between how the models work versus how the markets work? The models work, we estimate some statistical model based on polls and other fundamental data. Andrew talked a bit about this. We might simulate electoral college outcomes, and then we report the proportion of times that each candidate wins. The markets have and this 89% actually is a frequency. It's the frequency of simulations in the case, at least that's how 538 works. And I take it that that's also how the economist model works, because it's using Bayesian models and Monte Carlo simulation. So that's actually a frequency, but it's a frequency of the proportion of simulations in which a certain event occurred. Okay, so what does it actually mean in the real world? That's one of the challenges. For prediction markets, the numbers have a very clear meaning. They are just the prices at which people were willing to trade on the outcome of an event. One yes contract on Biden costs 64 cents. It'll be worth $1 if he wins, 0 if he loses. We can turn these prices into implied probabilities in one of two ways. First is the 64-cent figure price, meaning that in order for this to be a profitable trade for me, Biden has to have at least a 64% chance to win. The other is as an implied probability. So that would be a break-even probability, 64%. The next is as an implied probability, which is to normalize these so they add up to 1. And in this case, it gives Biden 59, Trump 41. So we see the 30% in absolute percentage points, but a very big difference in terms of what the two are projecting. And there's arguments for and there's arguments against both of these approaches. So I'm going to run through arguments for and against, and I'm going to give an assessment in the end of which outperform the other, or perhaps it's hard to tell. And so for the case of argument for, so the argument for the polls is that it's based on data, it's based on the polling data. The argument for the models is that it's based on polling data, fundamental data. It's objective in that sense. We know where the numbers come from. We may not understand what those models are doing in some sense. Rajiv mentioned the negative correlation between certain states, which is hard to maybe comprehend. Models kind of have a mind of their own at some level, especially as they get more complex. But in principle, we know what's going on. They're based on well-developed statistical theory and methods, so it's scientific, and they can be tested in some ways. I guess the question is how. I mean, several people have talked about calibration, Breyer score. Are those really meaningful tests? We'll talk about those in a little bit. For the prediction markets, the argument in favor of this, at least from my perspective, is that there's very clear incentives of market participants. They're trying to make money, so there's a very objective metric. It's easy to understand what that metric is, even if it's hard to understand how the market arrives at its price. There's a bit of a well-documented idea, this idea of wisdom of the crowds that markets should be able to benefit from. And finally is that it's automatically tested in terms of profit and loss. If I put money in, I can come after the election, I can complain all I want about how unlucky I got, or how something weird happened that I didn't think about and that nobody thought about. But at the end of the day, did I make money or did I lose money? This happens to have been a snapshot of what my portfolio looked like at some point after the election. At this point, most of the markets had been settled, so that got folded into this portfolio value. But whatever was left outstanding, I was standing to lose at this point a few $100s. So not, as Andrew mentioned, not a ton of money to be made, at least in the predicted markets, not a ton to be lost either, but you could make a few tens of thousands if you do it right. And if you go to Betfair, there's certainly hundreds of thousands and millions of dollars being traded there. So there are professional political traders. They're in it for the money. And so that alone suggests to me that there is something to these markets. There should be something to these markets. But given the discrepancy between the models and the markets, it is worth considering the pros and cons of each. Okay, now the argument against the models or the polls, to some extent, is a lack of transparency. That's not necessarily true of the economist model, where at least the economist presidential model, where Andrew and his co-authors published, I believe, pretty much their entire methodology. But for 538, this is a bigger issue. Models aren't publicly available. And even if they are publicly available, and I would say this is true even of the economists, they're extremely hard to interpret. These Bayesian models are not, sure, you can put priors and parameters and hyperpriors and all that, and you can fit it and it all runs and it all works. But the more layers that we add to these models, the more complex they become, and the harder it is to know where some kind of what's actually going on. And again, the negative, the presence of negative correlations may be an example of that. There's certainly bias in the media. There's bias in the polls. We know that some polls are biased towards Democrats, some are biased towards Republicans, and that can, to some extent, that's the job of the model to try to tease that out. But there is but one argument against it is that whether or not the polls can actually influence the outcome of the election, as Andrew mentioned, he didn't think it necessarily could. They certainly can promote narratives that can disenfranchise voters and harm public trust in government and science. On the science front, we've seen some of this happening in real time with the COVID-19, the lack of trust in what people are saying there with respect to the elections. So the polls predicted that Biden was going to win, and he did win, but he didn't win by as much as maybe, or at least in the eyes of what a lot of people saw, whether this is true or not. He didn't win by as much as what the polls said. He didn't win by I don't know, 13 or 15 points in, I don't know if it was Wisconsin or wherever one of the polls had him up by a lot a few days before the election. And certainly there was a skew, as we see in this graphic below. This is a skew from Flip Pideaux at the American Civics Exchange, showing the polling error by state, that in 48 out of 50 states, the polling error was underestimating the Republican support, and in some cases by quite a bit. And only in New Mexico and California did they underestimate the Democratic support. So regardless of whether, the polls were actually pointing in the right direction, there was certainly an idea that there was bias in those polls, and that it promoted a false narrative that the election was more certain than it actually turned out to be. And there's always with the polls, since there's no skin in the game, there's no actual concrete losses to be suffered, there's always excuses that somebody can come up with. This is maybe my main gripe with 538, is that they always have a way of seemingly wiggling out of their of what they got right and what they got wrong. Gelman said something interesting, and this is why I wish he was here to maybe talk more about this, but he said something before the election saying that he's not trying to predict the outcome of the election. He's actually trying to forecast voter intentions. And so this I think maybe raises the question of what you're actually forecasting, because if the outcome of the election is not a reflection of voter intentions, then how are we going to assess whether the model actually was good or was bad? And like I said before, modelers and pollsters in general face very little risk of being wrong, especially when they all tend to agree. If all of them think Biden's going to win and then Biden loses, well, they're all wrong together, which is kind of what happened in 2016. And so there, it's just, we can chalk it up to a statistical anomaly, perhaps, and nobody really is on the hook. Now, what's the argument against the markets is that the participants have their own political biases. This is the so-called MAGA money. Markets can certainly be manipulated. The predictive markets are probably harder to manipulate. They're probably much less efficient, and they're harder to manipulate for the same reason, which is that they have a very low cap, $850 per contract, and so they're harder to manipulate. But there was a Romney whale in 2012. There was a manipulation of markets in 2004, Gore versus Bush Kerry on the in trade. Crowds generally aren't wise. There's obvious market efficiencies caused by trader cap, max bet, long shot bias, transaction fees, and so on. And so the interesting thing about this that a lot of people pointed to as an inefficiency was that as of December 1st, this was what Predicted looked like. This is what Betfair looked like. Betfair, you could still be betting on Biden, and you would put up, you would basically be buying Biden at 95 cents for $1 on Betfair, and look at how much money's here. Let's see, something in the realm of $5 million on either side. So there was money to be made. And this was a month or so after the election was supposed to be over. Let's think about how can we evaluate forecasts. The usual metrics, which I take it most are familiar with: calibration, which is a sign of unbiasedness. 10% of your 10% predictions happen, 20% of your 20% predictions happen. And then accuracy, how close are you to the truth? If something happens, I want to give it 100% probability, ideally. If something doesn't happen, I want to give it 0% probability. What are some of the drawbacks to these metrics? I'm not going to dwell too much on these, but for my taste, they're a bit too abstract. Well, one, they're abstract, and two, they don't necessarily actually assess what we want to assess. Calibration does not imply accuracy. This is a well-known thing, and I'm going to show this with an illustration involving the markets and the models in the next slide, or one of the next slides. The accuracy measure in terms of Breyer score or any kind of scoring is a bit abstract. It certainly is something, but it's hard to know exactly what having a good Breyer score means in a real world context, and in particular, accurate relative to what. And this is an illustration from 538. They actually do compute Breyer scores for all of their forecasts, which involves baseball games, sporting events, and also politics. And according to their assessment, their self-assessment, you can see that they are on the correct side of the good side of the line, in the sense that they are outperforming this so-called unskilled forecaster in all of their forecasts. Now, for politics, they are way over. They're way better than this unskilled forecaster. For baseball, they're barely better. Now, what is this unskilled forecaster doing? The unskilled forecaster is just assigning 50-50 to every single event. So that's maybe a baseline. If you were doing worse than that, there's a problem. But it would be pretty bad to not be beating that unskilled forecaster. And anybody who knows, about their sporting content is not very strong at all. A better comparison there would be to compare it to the sports books, the betting markets there, where people are actually betting a lot of money on sports. And for politics, we know that putting 50-50 on Alabama, Trump to win Alabama, 50-50 on Biden to win California, you don't need to have a very strong model to beat that forecaster either. So this isn't especially informative as to whether or not the 538 forecasts are all that great. So we can actually compute calibration scores for 538 and for Predicted. I'm not going to get into the weeds on what these numbers are or what these tables are actually saying, but we can bin the probabilities. How often does 538 put a probability in the 0 to 5%, 5% to 15%, all these ranges? Based on their own assessment, what is the number of expected outcomes? Based on the observations, what is the number of actual outcomes? And we can compare those and we can test those. And when we do that for 538, we see that they're extremely well calibrated. When we do it for Predicted, we also see that Predicted is well calibrated. It has a p-value of 0.89 versus a p-value of 0.99. I don't know if we should be comparing these p-values, but they're both extremely well calibrated, and there's some issues with calibration of Predicted, especially where that's going to come from is especially in the tails of the distribution, where for well-known reasons, Predicted, you or I or anybody could have bought Joe Biden to win California on the morning of the election for 94 cents. So we could have invested 94 cents and gotten essentially a guaranteed $1 or $1 with 99.9% probability. That's due to a lot of the distortions that come from the transaction fees in predicted and other issues that could really be solved with better market design. But I'll talk about those a bit in the end. So just comparing these two side by side in terms of calibration, there's really nothing to look at. They're both well calibrated. This doesn't really prove anything. I personally care more about accuracy than calibration. And so if we were to look at them in terms of accuracy, in terms of the Breyer score, there's this, okay, this slide's a little bit of a mess, but let's just look at this top table here. If we look at if we look at all races and we compute the Breyer score, 538 has and this is all races. What I mean by that is House, Senate, and presidential. Okay, I got it, Dave. House, Senate, and presidential. 538 has a lower Breyer score. If we look at it only on the events for which the forecast is between 6% and 94%, then predicted takes a slight lead, but it's not really significant. Now, why do I choose this? That's again because of this known biases in the tails of prediction markets. So that's just to give you an idea. So on Breyer score alone, 538 has the edge, but that edge is coming from those tail events, the events that nobody really cares about anyway, because we think we know what's going to happen. But what I want to compare is actually, what if I did a much more naive prediction strategy, which is that I just looked to 4 years back. I looked back at 2016, and I'm just going to predict with 100% probability that Trump is going to win all the same states he won in 2016, and that Biden's going to win all the states that Hillary Clinton won in 2016. If I do that, how many states would I have gotten right, and what would my Breyer score have been? Well, this is actually for all of the years going back to 2004, that using this strategy actually gives me a reasonable Breyer score. The only year where this was pretty bad was in 2008. What if I wanted to be a little bit more sophisticated? And I'm not going to just say 100% or 0%, but there's definitely some toss-up states. If the predicted price is between 10% and 90%, let me just assign that a 50-50. If I do that, I get a Breyer score of 5%. So I'm not saying that this is a good strategy, but if what I'm trying to do is maximize Breyer score, it's not clear to me that either of these methods is giving me any additional insight over just looking 4 years back and saying that the Republicans tend to win Alabama, so I'm going to predict that they win Alabama again, and that Democrats tend to win California. Now, if we had another scoring rule, log score, this method would be horrible, because if you get a single one wrong, then you're in trouble, because a single one that you gave 100% probability wrong, then you're in trouble. So what we did in our paper was we did something which we called market-based scoring, which is very similar to, it may even be essentially the same idea as what Rajiv showed, which is we're going to come up with a strategy based on the model. We're going to come up with a trading strategy. We're going to act like we're trading in the markets based on some method of sizing our investments. Rajiv had his way of sizing investments, and I have some much simpler and cruder ways of doing it. And we're going to see whether we would have made money or lost money. Okay. And I'm not going to get into the technicalities here. They're not really that interesting. But two ways that we looked at was a dollar cost averaging approach, which is that we just buy some fixed amount of money. This is not buy one share. This is buy some amount of dollars worth of shares if we determine them to be undervalued relative to the model. Otherwise, we sell our shares, and Kelly criterion is related to, it's similar to it might even be the same as the log wealth optimization that Rajiv showed, and there's a fraction for that. Okay, this is just a little bit more of this. We actually tracked this throughout the election cycle. We tracked it throughout the cycle, and we put it at this app, and I'm not sure if the app's still up, but we tracked it daily just to see what was happening. For the most part, not a whole lot happened until the election. But there was some pre-registration of the analysis to make sure I'm not cherry picking after the fact. And so I called this market-based scoring. So this was this was market-based scoring. Then I'm scoring the models based on how they would perform if they were investing in the markets. What are some arguments for and against this? Is that it's a concrete metric, it has a clear interpretation, and there's clear incentives with clear concrete consequences. The arguments against it is that Nate Silver has argued it's unethical to bet on your own forecast. Gelman said today that he would feel a little bit guilty about it. I actually think it's the opposite. It's unethical not to bet on your public forecast. It's unethical not to have your risks aligned with whoever might be reading into your forecast. And Silver has said many things about how markets are dumb and we shouldn't even bother looking at them. So these are some bold claims, but are they actually true? And so if we actually go through and we look at the performance, it's a bit of a mixed bag. So Rajiv showed a 16% return based on his strategy, and also, as I understand it, not considering transaction costs. And he was looking only at a few, maybe 13 to 15 of the presidential battleground states. And then he was also looking at the economist model versus the 538 model. So there are some differences there that could lead to differences in these numbers. The closest comparison I could come to here is what we get when we use the Kelly criterion, which is close to his log growth optimization without considering any transaction fees. And for the presidential election, although I'm looking at presidential for all 50 states, in that case, 538 would get a 5.3% return. That's lower than the 16% Rajiv showed, but you have to realize that this number is going to be diluted because of all the small, basically a lot of the edge here is coming from picking up pennies in California, Alabama, Mississippi. You're going to make 2-3% almost guaranteed. And you're going to bet a lot of money on those. So that's going to really dilute the ROI here, but it does give you a profitable. If you look across, so the presidential actually was profitable in the top line without any fees. Senate and House were not profitable even without fees. And we know that presidential was won by a Democrat, but the Democrats underperformed Senate and House. So that's consistent with that overall story. When we start to take into account commissions and fees, though, the story becomes different. So overall, we see that based on either strategy, at least that I looked at, once all of these things are taken into account, actually the models are losers in the market. And so what is this all to say in terms of what are the conclusions here is that on their own, models don't beat the markets, but I wouldn't really expect them to beat them on their own. Something like Rajiv said, the averaging between the two, or something a little bit more sophisticated is going to be needed to actually make real money in these markets when we account for the real world factors of transaction costs and so on. But they are certainly competitive on abstract metrics. Markets should certainly be better than they are. They're not as dumb as people claim. They're not as dumb as Nate Silver claims, but they're not as sharp as they could be. There's plenty of inefficiencies. They could be designed better for a number of reasons. And this last thing is that, it's not enough just to act like you're betting in the markets. I do think that there needs to be real risk in order to make sure that when something is said, it's actually backed up by some kind of action. Otherwise, it's very easy to say. I mean, how many people after 2016 said, oh yeah, I knew Trump was going to win. I just had a feeling. Well, that's always the case. We always had a feeling after something actually happened. It's with forecasting, we need to know that ahead of time, of course. So the paper that I talked about here is this first paper. The paper that kind of got this started for me was back in 2018. It's not as detailed. They're both on the Researchers One site. And if I can, just for one last second, I wanted to talk about what I was talking about here was how forecasting and all of that plays into public policy. It plays into public perception. And we have some events on Researchers One. One is next week on the vaccine. So we're going to talk about maybe some questions about the effectiveness of the vaccine, the statistics, the statistical approaches, the randomized trials. And we actually are in the pipeline working on a political prediction market conference in April or May. So these are some events that you might be interested in as people who've attended this conference. There's another conference that we're working on with the Imprecise Probability Society as well. So I would say stay tuned for that, but I'm happy to take questions now and appreciate your attention.
Great. Thank you so much. Really, really interesting and a great way to end the third day of talks. We have a couple minutes for questions. And Jens asked a question. He says, you alluded to possible market design solutions to the long shot bias in prediction markets. Are you thinking of like the fee structure, or a different kind of fee structure, or how do you think it could be solved?
Yeah. So one of the ways is that the fee structure that, well, what is causing the long shot bias? Well, if it's a long shot bias, then it's a long shot bias. It's because people tend to bet on long shots because they want the big payoff. But what is maybe exacerbating the long shot bias is the fact that, well, there is this 5%. So there is this 5% transaction fee just to take money off the site, right? So this is predicted. So I mentioned that Biden was selling at 94 cents on election morning to win California. So you look at that without any fees and you say, I'm just going to make 6% or some 6.5% for free in one day. That's great. Add in that 5% transaction fee plus the 10% profit, which is a fee on profits. That 6-point-whatever% return actually turns into about a 0.4% return. So that's what's exacerbating this long shot bias, is that it's actually not a bias at all. It's not even an irrationality in the market. It's a completely rational response to the transaction costs. It's not worth it for me to put my money on that site. The maximum is $850. At 0.5%, I can make $4 off of that, right? So I think that the transaction costs and the fee structure was actually also asymmetric on predicted, because if I buy something at a penny and it goes to $1, I'm paying 10% of 99 cents. I'm paying 10 cents in fees, as opposed to if I buy something at 99 cents and it goes to $1, I'm paying a fraction of a penny in fees. So those are two of the main ones, I think.
Okay. One last question, and then we'll end the session. James on the chat asks, and it's related to a question I was going to ask, is like, if you sort of insist that forecasters place a bet, do you kind of conflate their belief and their utility, and like conflate their forecast with how they manage their money? And then my question was sort of, would tracking be enough? Like if we just kept really, really good tracking of this Breyer score of all of these people, would that be satisfy what you want?
So for the tracking question, well, maybe, but here, let me clarify what I was saying. I was saying you have to bet. Of course, that's a little bit of a strong statement, but what do I mean by it? People have their own way of managing their own money. People have different risk profiles, et cetera, et cetera. For me, though, I look at the forecast that's put out by The Economist or by 538. I'm not too concerned. No offense. I don't care how they manage their money. I'm not concerned about their personal beliefs on how to take risks. I care about what the numbers they give me means. So for me, I can't actually put much meaning into what they say unless I know that the thing is actually tied to something I understand. And the only thing I can understand, since I can't get into their heads, is the dollars and cents that they're willing to put up. So I think that, there's this. So what I mean by that specifically is that when you get into markets, there's a huge difference between something selling for 80 cents and something selling for 84 cents. But when you look at a number on a piece of paper, 84% versus 80%, that intuitively doesn't feel all that different. And so if we want to really get these things sharp, if we want these to be really sharp, that's where I think that the trading really would help to make them more meaningful, at least to me, because it's something that I understand. That's really all I say there. I realize it's a bit much to ask and it's not really realistic, but I would also contrast it with, I don't think that it's in any way unethical. I think that that's an absurdity to say that it's unethical to take risks based on forecasts that you are claiming to believe in. So I would, and that's not something Gelman said to my knowledge. That's something that Silver has said. Would a tracking thing work? I don't know, because again, you get into this. I guess if what's my reward for beating you in Breyer score? I guess I get bragging rights. But if I'm a little bit close to you, like the 80% thing, is anybody really going to notice? Whereas I certainly would notice if I was making less money than you or making more money than you. So I'm not sure. I don't know.
Okay, great. Thank you again.